Gogoro's Q2 2026 earnings just dropped. And while there wasn't an official consensus estimate, there was this massive year-over-year bottom line improvement.
Yeah, revenue actually hit $70.6 million, so that's up 7.3% year over year.
Right, and EPS came in at negative $0.24, reflecting a really solid $21.6 million improvement in their net loss.
Plus, they reaffirmed their full year 2026 revenue guidance, holding steady at that $285 million to $305 million mark.
But despite all those improvements, shares just plummeted, like roughly 10% to 15% pre-market and intraday, tipping right near 52-week lows at $2.05.
It was a pretty brutal reaction from the market.
Okay, let's unpack this. Why did the market brutally punish the stock when revenue is up and the net loss shrank so drastically?
Well, the answer to that drop is really hiding beneath the headline numbers, specifically in their segment mix and the balance sheet. So starting with margins, gross margin exploded to a 5-year high of 22.6%, which is massive considering it was at like 0.3%.
That's because those really costly battery upgrades finally ended, right?
Yeah, exactly. And with that weight gone, hardware revenue jumped 17.8% to $33.2 million.
Wow.
Yeah, it was mostly driven by partner deliveries for Wemo and some new entry-level suitors. But there is a catch.
There always is.
Yeah, battery swapping revenue actually dipped 0.6% to $37.4 million, even though subscribers grew 4% to 677,000.
I mean, it's basically a razor and blades model, but it feels like it's backfiring a bit here.
How so?
Well, selling cheaper razors, like those entry-level EZZ Y500 scooters, definitely attracts more subscribers.
Right.
But it completely drives down the average revenue per user because, well, these new riders just don't commute as much.
Right, so they buy fewer blades. And that hardware shift ties directly into management's new strategy, which CEO Henry Chang is calling a product renaissance.
Well, product renaissance.
Yeah, they're specifically targeting female riders now with their new Luna model. Oh, and side note, CFO Bruce Aitken is actually retiring.
Which brings us to the underlying risks really spooking retail investors right now. Because, they have a 3.26 debt-to-equity ratio.
It's a lot of leverage.
Yeah.
And the current ratio is sitting at 0.79, which shows some severe short-term liquidity constraints.
Especially with a pretty soft Taiwanese market.
Yeah.
But wait, let me push back on this for a second.
Sure.
Management is promising that the battery network will actually hit profitability this year. So does that even matter if their glaring liquidity crunch prevents them from operating smoothly?
I mean, not really. Profitability is a great milestone, obviously, but with a 0.79 current ratio, for every dollar of near-term debt, they only have 79 cents in liquid assets.
Right. You can't pay vendors with promises of future profits.
Exactly. I mean,
Yeah.
if you literally don't have the cash to keep the lights on, the whole system just grinds to a halt.
So here is a question to mull over as you watch this play out. With their upcoming launch in Vietnam, will Gogoro's overseas expansion scale fast enough to save their balance sheet? Or will these liquidity constraints stall their engine before they even gain traction abroad?
It's definitely a massive race against the clock.
It really is. Make sure you follow the show for your daily earnings deep dive, and we will catch you tomorrow.